Imagine a busy Saturday market, some stalls selling fresh fruit and others selling rare collectibles. The fruit stalls are always busy with buyers and sellers. You can hawk in, pay, and hawk out immediately. The collectibles, on the other hand, might have one or two buyers throughout the day. You might have to wait hours or days for someone to simply agree on a price. That's liquidity. The fruit stall is high liquidity, easy to buy or sell, little price changes, right? The collectibles is essentially low liquidity and hard to buy or sell. That was a quick analogy just about liquidity. What's up, everybody? It's your boy Marcelino, and welcome back to another Modern Day Trader video. If you're new here, as I mentioned, I'm Marcelino, a professional accountant and an aspiring funded trader, walking through the new skill that is ICT concepts and just trying to forge my own understanding on what it is. So I've been through a full month of understanding liquidity and kind of getting my own definition of it and my own understanding of it, hence the analogy at the start. And so without further ado, let me just walk you through, on top of what I just explained, the real life explanation that I gave you. On top of that, let me just give you a little explanation of what I think liquidity is in economics, and then also applying it to trading. So with that analogy, let me just jump straight into the economics explanation. So in economics, liquidity means how easily an asset can be converted into cash without losing much value. Cash in and of itself is the most liquid asset. It's accepted everywhere instantly, right? And we all know that. Assets like property and art are pretty much illiquid in that you need time to negotiate to turn them over into spendable money, right? So now how do we actually apply this to trading? In the Forex markets, liquidity shows up as the number of buyers and sellers at any given moment. Pairs like Euro USD are very liquid because they are traded in a very busy market condition, pretty much, right? The spreads are small and orders get filled quickly just because it is a major pair and majority of people are trading it. Exotic pairs, on the other hand, are very low volume, and at times, essentially, they like the collector's art that I was explaining, right? It's harder for orders to be filled, which means spreads will be wider and prices can jump around quite a bit, essentially, right? And so just having that same analogy that I had about the farmer's market, exotic pairs are essentially like the collectors, and then Euro USD, since it's vastly different compared to exotic pairs because it's traded quite often, it's like the fruit stalls essentially. So liquidity isn't just about volume, it's more about depth too. Economically, it reflects how much demand and supply are stacked at different prices essentially. That's why big institutions look for pools of liquidity, areas where there are pending orders like above previous swing highs and above previous swing lows. When those orders get triggered, it gives them the ability to buy or sell large positions without shocking the market too much. So we're looking for areas and pockets in the market where price action has pools of liquidity so that we can buy below a swing low or we can sell below a swing high, right? So that's essentially what we're looking at. Liquidity is basically ease of exchange. In the markets, high liquidity means smooth, fair trading. Low liquidity essentially means waiting longer and possibly paying more. Going back to the fruit and the collectible store, essentially, right? As a trader, your job is to understand where liquidity is and how prices interact with it. Because where liquidity is where the big players operate, right? So with that being said, my studies over the past month on liquidity basically is I haven't been looking at it from a market structure perspective. I've been looking at it from a previous weekly high, previous weekly low perspective, previous daily high, previous daily low perspective, and previous monthly high, monthly low perspective, and then previous session high, session low perspective. And the reason for this is that more often than not, there are liquidities above these timely points instead of looking at market structure and saying, okay, this is clearly a higher low, higher high. From my perspective, on an intraday basis, I can draw a previous daily high, daily low level quite clearly. I can draw previous weekly low, weekly high level, and not try and look at the markets and say, oh no, this is a potential higher low, that's a higher high, higher low, higher high, and now price action should now come and sweep these lows to then push to the upside. Doing that, it's very subjective. You end up essentially looking for price action to trade into areas where it could potentially get to or it could not. Whereas if you're using previous daily highs, daily lows, or previous weekly highs, weekly lows, you know there's a high chance that if you're biased, which is a different subject for another day, if your bias is correct, once we do sweep highs or lows and we have an anticipated bias, there's a high chance that price action could move in that direction, right? So all we're doing as traders is curating and narrating the story of a bias that we have based on a higher time frame, which could be either the daily or the weekly, and building a story for liquidity pools on the day based off from that bias. So for example, if we look at Euro USD, right, and as I mentioned, liquidity points are essentially the point at which buyers and sellers exchange goods, the point at which buyers and sellers exchange anything, demand and supply, essentially, right? So you're trying to find out where those liquidity areas are. Those liquidity areas are at the points that I mentioned. So if we're trading with that in mind and trading with that easy model of liquidity is placed below and above previous daily highs and lows, previous weekly lows and highs, and previous session highs and lows, all you need to do is start to mark those areas and look at the reaction off from those areas. Now, we're not saying that you pretty much going to be buying immediately when price action takes out a low and then just cross your fingers and hope that it's going to go up again. No, there's the biased, which is your higher level, or your basically your higher picture or overview of everything. Then you get your evidence, which is your lower time frame things and the sweep of liquidity, and then you get your confirmation, which is your entry point, right? So those are the three levels of confirmation that I basically like to use. But just based on liquidity and anticipating where you could essentially look for trades and then pairing that with time and price, what you want to do is essentially take the previous weekly high and the previous weekly low, mark that on your chart, and then anticipate where price action is going to go, have your weekly bias, and start to think what's going to happen. Are we more likely than not going to take out the weekly low and then push to the previous weekly high? Or are we going to take out the previous daily low and push to the previous daily high? What are we going to do based on our higher time frame bias? And then when we do take out and sweep those lows or those highs, what is the reaction off from those areas? That's all you're going to be doing, and that's all I've been doing. And what I've realized is that there is a high chance that if you do have your bias right, that the previous daily low and daily high will get swept. If there's a reaction off from that and you see the 15-minute market structure starts to shift, then that is more likely than not a sweep, and we could potentially start to, let's say in this case on Euro USD, we sweep the lows. There's a high chance now that price action could push to the upside and meet the previous daily high, right? So with this particular trade on Wednesday, right, what I had in mind was my bias for the week was bullish based on multiple time frame analysis, my bias for the week was bullish, and what I'm anticipating is that price action was going to come and potentially sweep this daily low and then push to the upside. Now what you can see is, so I always mark my previous weekly high and my previous weekly low, just because I know those are, as I mentioned, liquidity pools for price action to get magnetized to and then sweep and then potentially push away from. So I had this on whole week, and coming into the markets at about Wednesday morning, I saw that Tuesday had already closed bullish. So now I'm anticipating, okay, there's a high chance that if we do sweep these lows, we're going to push to the upside. Now, I didn't intend on trading off from the weekly low, but I knew that it was there because I marked it at the start of the week. And because I'm bullish for the week, if we do get a shift of structure on a 15-minute in these areas after sweeping it, and it aligns with my times that I'm looking for, New York kill zone, London kill zone, and there's a potential entry, then I will be looking for that. So that's all we basically do. We're trying to see what the reactions are from these key levels, and you will always see when these previous weekly lows, previous monthly lows get swept, there's a high chance that a reaction out of that area will occur. Now your goal as a trader is to execute on that reaction. It's to execute and take the movement in your bias direction, right? So we jumped onto the 15-minute time frame, and all we pretty much did was anticipate initially London session. I'm looking for price action to take the previous daily low and then get the reaction to possibly break these highs, right? You can see that London, we just pretty much destroyed the previous daily low. And at this point, I'm telling myself, okay, there's no trade in London session. There's absolutely no trade on Euro USD. I'm just pretty much hawking away. I'll come back pre-New York at about 12 o'clock just to do analysis and see exactly what is happening, if I could potentially get a trade, right? So we're coming into the weekly low, and a lot of people, after we sweep the daily low, because they don't necessarily take the weekly low into account, they wouldn't even think about trading this pair anymore, because they're going to say, oh no, we invalidated this area, we probably looked at the 4H time frame and we had an order block in these areas here, and we swept below the order block, so it's more likely than not going to move in my direction. So for me, I look at these liquidity pools and I anticipate that if we do indeed have a reaction and we can start to break market structure as indicated here, then the chances of us pushing higher is quite high. Because if we were going to continue, then what we would have done was pulled back, and we wouldn't have struggled to break this intraday liquidity. We would have just continued to make lower lows, lower highs, and this previous weekly low would have just been raided completely, right? So my whole thought process was that in London session between 8 and 11, initially to buy off from this, not to buy off from this area, to buy once we pretty much broke above this. We failed to break. We went into the weekly low. You can see we had a reaction initially late in the kill zone time. So now I can't trade between 11 and 1 pretty much. Like, that's a no trade time frame for me, or time in the day for me. So I waited. I could see that we made this potential lower high with the potential to push lower, and then we failed to make the lower low, and then what you can see is that we got the break of structure in my session or in my trading time. This now gives me the indication and the evidence that the buyers are stepping in. And just like the fruit store, there was an agreement on prices to say, listen, I like the fruit at 1.15830. Can we agree on a price? And that's basically it. Once you can clearly see where liquidity is, and it's not that hard, it's just based on previous daily low and daily high, previous weekly, those areas that I mentioned, and it's based on reactions. When you don't get that reaction and you don't get the break of structure, what that simply means is that essentially the prices fell through and you didn't agree on a price. That's basically what it means. It means that you as a buyer and the fruit stall person who's working there, we didn't come to an agreement on a price, and I wanted it at a certain price and he wasn't willing to sell, and that's that, and you just keep on moving. You didn't get an indication to say, or you didn't get the evidence to say that this person wants to essentially sell it to you at the certain price for you to buy. Basically, that's liquidity in a nutshell, right? And so once I got the break of liquidity, all I did was I anticipated the OTE entry, so the optimal trade entry. And the reason for that was simply because I was driving, and my theory behind it is that you want to essentially have models and entry models for every occasion. And for me, the OTE model essentially takes away all the thinking. It just says that if you anticipate in price going up, you're pretty much going to place a fib, and on the 61.8% or 62%, you're going to place your buy limit or your sell limit. Your stop's going to go below 0 or 1, and then you're going to, like, for me, I'm targeting the previous daily high or slightly below the previous daily high. And the reason for that was because my bias was bullish. I got the reaction, and all I can now do is anticipate that price action is going to go up. And now for those people that think I didn't actually take the trade, let's walk through all of my thought processes throughout the day. So we had the news outlook, then we had Euro AUD on watch, we had Euro USD on watch, and you can see that I give the breakdown of everything. So you can see prior to London session, so this was already forming a daily bearish candle at that point. And imagine a lot of people, once this daily candle is looking like this, a lot of people is anticipating sell-offs. Now if you did sell in London, you made money if you took profit at the weekly lows. If you took profit. Now I know that a lot of people probably didn't, but if you did, you made money. And all I'm doing is that I'm anticipating a reaction from the previous daily low or the previous weekly low to agree with my buyers. So you can see I broke down the 15-minute, just stating my expectations in the time frames that I trade, and then just giving updates throughout the day, clearly stating what I'm thinking, what price action could potentially be doing. And then you can see, so London, there was no particular trades. Then I got to New York, I just stated what exactly I need, and here you can see what I stated for Euro USD. And at this point, Euro USD had just formed, I think, these lows, and I was anticipating that price action moves above these areas right here. And what you can see is that price action broke above structure, and right before I left work at 3 o'clock, I think this break of the high was at about 2:30. So 2:30 to a 2:15 to 2:30. And all I'm doing is I'm anticipating that now, because we swept liquidity, we landed on prices for better buying prices, essentially taking out all the stops below that weekly low area. I'm anticipating the price action could potentially push to the upside. And as you can see, once triggered in, the rest was history. And that's my understanding of liquidity. My goal now for the next 2 weeks is to kind of combine liquidity and times of day, understanding when the weekly low, weekly high formed, when the daily high, daily low forms, and then when session high, session low forms. Over the past, I need at least a 20 set of data for each time frame. So for the weekly, for the daily, for the session based, so for the London and New York. And what this gives you is kind of the average time in which a daily low is formed and daily high is formed. It gives you the average time or the average day in which the weekly high and the weekly low is formed, obviously within a given bias, and similarly for the session. And essentially when you do this, you kind of put in the thought process of liquidity together with a stat-based trading system. So when you have the stats that, let's say, for instance, if you're looking at a session, let's say London session, for example, when you're looking at London session, if you trade in London session and you have the stats that based off from, let's say, the previous 3 months, the low in a bullish London session or in an anticipated bullish London session is formed at 9 to 10 South African Standard Time, you know that if on average that occurs 70% of the time and you bullish on the day, you know that you need to be way more aware in that 9 to 10 hour on the charts than anything. And you know that you're probably going to have a higher win rate when you do take trades in that time. And so that's going to be my next step in liquidity. And I don't necessarily want to say seasonality, but that's the next step in my trading plan, or formulating my trading plan, because now we understand that the previous daily high and daily low is a highly reactive key level in the market. Previous weekly high and weekly low is a highly reactive area in the market, and then similarly for monthly and session based liquidity. So like, now that we know that, how do we build on that? And my method of building on that is by getting the stats for when these lows and highs are formed, what times are it formed, what days are it formed, and within the session, in what hour is it formed, essentially. And then what you can do is you can add that to your plan of liquidity, quote unquote, to have a higher hit rate, to hold for longer, essentially, if you want to be a swing trader, or to know and have more confidence and conviction in your entry. And so that's my plan. That's my understanding of liquidity. I really hope that this was helpful to everybody that listened to this. And with that being said, please don't forget that failure is feedback, feedback is knowledge, and knowledge is power. I hope that every single one of you have a profitable week. I hope that every single one of you are ironclad in your trading plan and continuing to grow your trading plan and your trading database, essentially. So with that being said, from your boy at the Modern Day Trader, peace out, man.